Hello everyone, I hope you guys are doing well and studies are going in full swing. In today's video, we would be discussing the all-important Ind AS 23 on borrowing cost from your CA Final FR. So this is a fairly important standard. You do get Ind AS 23 as standalone questions, and a lot of times you do get Ind AS 23 as a part of a larger, let's say PP or other assets question. So it is a fairly important standard. Two fairly important points over here. One is the treatment of foreign exchange in case of certain foreign currency loans as borrowing cost, and second is the accounting in case of a comprehensive question pertaining to specific as well as general borrowings. So let us cover everything with the important questions on this. So time to get started. When you look at Ind AS 23, this is similar to your CA Inter AS 16, which is on borrowing cost. Now usually borrowing costs are financing in nature, and because they're financing in nature, the amount that you pay should ideally go to the profit and loss. When you prepare your cost sheet, you don't really add interest into the cost of an asset. However, in case of special assets which are treated as qualifying assets, what does happen is, if you follow the same principle, the interest will keep on going to the profit and loss account. However, if these assets take 3, 4, 5 years to make, over these 3, 4, 5 years, you're not earning any revenue, but interest is going to the P&L. And hence, Institute decided that for certain special assets, which we call as qualifying assets, borrowing cost which is incurred during the period of construction should be capitalized. Later, borrowing costs can be taken to the profit and loss account, but during the period of construction, it can be capitalized. Now, what do you mean by borrowing costs being capitalized? Let us say an entity takes a loan of 100 crores, rate of interest is 10%, uses that money to buy or construct an asset which is taking, let us say, 1 or 2 years. That is, it is a qualifying asset, let us say for the time being. In which case, for the first year, they will pay an interest of 10 crores. So your journal entry for the same would be interest account debit to bank, and ideally being a nominal account, P&L account debit to interest. However, Ind AS 23 says that if this interest was paid, that is, it was directly attributable to construction, acquisition or purchase of a qualifying asset, then this interest should ideally be capitalized. When I say capitalized, it means interest account debit to bank 10, but then asset account debit to interest. So rather than transferring it to P&L, you will capitalize it along with the cost of the asset. So the cost of the asset increases, and then subsequently when it starts earning income, then the corresponding depreciation that is getting charged will also accordingly be slightly higher. So you are trying to match the income and the expenses and not take the borrowing cost directly to the profit and loss account. Now, for other assets that are not qualifying asset, then whatever is the interest cost will directly be taken to the profit and loss account, and it will not be capitalized along with the cost of the asset. Now, if let us say there is an asset which is taking, let us say, 3 months, or if it's an asset which is taking 6 months, how do you figure out whether it is a qualifying asset or not? So the standard says qualifying assets are those assets which normally, that is ordinarily, that is usually, normally take a substantial period of time to be ready for their intended use. Now, how do you define a substantial period of time? Well, usually substantial period of time is defined to be 12 months from a student reference perspective, unless a question tells you other way around. However, the management can very well take a period which is shorter or even longer than 12 months in case of acts of the case demand. Like I might be a technology company, for me 6 months is also a significantly long period, and hence my board has decided that 6 months is the threshold, in which case if my project takes even 8 months ordinarily, then that will be a qualifying asset. However, if nothing is given, we can take 12 months as a barrier. Now, what we also need to remember is the asset should ordinarily take a substantial period of time. So let us say the cutoff is 12 months, your asset ordinarily take 8 months, but you are very lethargic and lazy, so you took 18 months. Does that make your asset a qualifying asset? Answer is no. The asset can ordinarily be made in 8 months. If you take more than that and maybe take 18 months, that does not make it a qualifying asset. It is a qualifying asset if the asset ordinarily takes a substantial period of time, where substantial period of time is usually 12 months if the question remains silent. But if the question specifically takes a shorter or longer period, you can take that. In certain questions, especially in the borrowing cost chapter, you would just be given a single year and you would be told that find the borrowing cost to be capitalized. Now, in such a case, some students might say that it is just 1 year or less than a year. So, is it a qualifying asset? Well, if the question specifically asks you to find the borrowing cost to be capitalized, in general, the institute treats it as a qualifying asset and does the calculation for the capitalization of borrowing cost. This is something that you have to remember. So over here, this is regarding the accounting for borrowing costs, where the important thing is you will take asset account debit to bank when you are capitalizing it, and you are capitalizing it for a qualifying asset which necessarily takes a substantial period of time. Now, usually this standard is applicable to all assets which take a substantial period of time, which can be PP, which can be intangibles, which can even be inventories. If they're taking a substantial period of time, it is qualifying assets and not just qualifying PP. However, there are scope exclusions, that is where the standard will not apply. First, being assets to be recorded at fair value from initial recognition. Like a biological asset, as per Ind AS 41, will be recorded at fair value less cost to sell. Now, fair value is all inclusive, and hence, if you're showing the asset initially as well as subsequently at fair value, you don't need to add anything extra, because like you look at an under construction flat versus a ready to move flat, a ready to move flat will be more expensive because the seller will also try to recover the interest that he had to incur, and as a result we don't need to separately add any interest. So over here, asset to be recorded on fair value, you don't again need to apply capitalization principles of Ind AS 23. Second, if you look at items like inventory, even inventory can be a qualifying asset. However, if for a business, inventory is manufactured in large quantities using a largely repetitive process, you have been exempted from capitalizing inventory in the interest of materiality and the time which would have to be taken to match interest to each item of inventory. However, I don't have a blanket exemption of inventory. That means if I am a business like a shipbuilding company manufacturing, let us say, ships, one ship takes 5 years. Now, a ship is not mass produced. And hence, for a shipbuilding company like a Bharti shipyard or an ABG shipyard, the inventories, which is a ship, will also be a qualifying asset to which borrowing costs will be capitalized if the entity had taken a borrowing. However, if I'm a wine manufacturing company, in which case I'm manufacturing wine in large quantities using repetitive processes, then I might be exempted from applying Ind AS 23 requirements. This is there in Ind AS 23. It was not there in the earlier AS 16. Also, financial assets like investment in shares, investment in debentures, etc. are ready for use from day one. And as a result, if you have taken a loan to invest in shares or invest in debentures, even if it is shares or debentures of your subsidiary company, this will not be a qualifying asset, and hence interest cost will go to the P&L account. This is for the SFS of the entity when you are doing CFS, and if you have invested in the subsidiary, you will have to see where the subsidiary is utilizing that money, and if it is utilized in a qualifying asset, then probably CFS treatment might be different, and we will do a separate discussion for the same as well. So over here, assets which are recorded at fair value and inventories which get manufactured in large quantities, they are exempted. Again, financial assets are usually ready for use and hence will not be covered under Ind AS 23 principles. Okay, next you look at borrowing costs. Now, borrowing cost includes what? Every cost connected to borrowing. The most classic example of a borrowing cost is coupon interest that you pay on a loan, 100 rupees loan, 10% interest. That is a classic example of a borrowing cost. However, borrowing cost is a wider term than interest, and hence it covers even other items, like for example, discount on issue of a zero coupon bond, or processing fees or transaction charges in case of a loan. These are also costs connected to the borrowing and hence will be a part of a larger heading of borrowing cost. Now, as per Ind AS 109, your favorite financial instrument standard, these costs, if you have studied 109, these costs like discount charges or like probably processing fees are all included in a number called as effective interest rate or EIR, and as a result, interest expense which is recorded using the effective interest method as per 109 will include all the effect of all of these charges, and hence this will be treated within the larger heading of borrowing cost. Again, when you look at leases, Ind AS 116, you will create a right of use asset and a corresponding lease liability. Each year on the lease liability, you will recognize interest. And hence, this interest on the lease liability will also be interest on account of a borrowing, which can be taken as a borrowing cost if it is for a qualifying asset. So these two are fairly obvious: finance charges in case of a lease liability or interest using the effective interest method. Now, the third one is a little trickier one where you have exchange differences. Exchange differences on the principal component of a loan. So if there's a $100 loan and you have taken the loan at, let us say, 80 rupees, so that is 8,000 rupees of loan. Now, loan is a monetary item and hence it will have to be restated at closing rate in each year. So at the end of the year, if the rate is 90, then 90 minus 80, that is equal to 10 rupees per dollar is the foreign exchange loss. Usually your entry is forex loss account debit to loan for 1,000 rupees. However, exchange differences on foreign currency borrowings to the extent they are considered as adjustment to interest costs. Now, what happens is usually if you have studied AFM foreign exchange, there is interest rate parity theory, which tries to say that countries which have a higher interest rate will typically have a weaker currency. And hence, it is accepted that, for example, if you were to take a loan in the US, which is having a 2% interest, as compared to a loan in India, which is having approximately a 12% interest, then the apparent 10% savings that you have in terms of interest will be offset by possibly a 10% loss approximately that you will have on the exchange on the exchange differences in case of loan. So if loosely there's a 10%, let us say, difference in interest rate, there's apparently a 10% saving. However, the standard believes that what you save in interest, you could possibly compensate by kind of paying a higher amount when you're repaying the principal. Like when you took the loan, you took it at, let us say, 80 rupees, that is 8,000 rupees, but when you go to repay it, probably you'll have to pay 9,000. So the 1,000 extra that you are paying is foreign exchange loss. But a part of this foreign exchange loss is also attributable to the differences in interest rate. So what I'm trying to say is there is a hidden interest component inside foreign currency loss as well. So how do I quantify that? So the standard over here gives you certain rules based on which we have a few steps. First, you will try to calculate interest of that loan in the foreign currency. We'll try to understand this with an example as well as some as well. You try to find interest on the loan on the foreign currency. So that is the actual interest. That is definitely a part of the borrowing cost. Compare that with the notional interest. Had this loan been taken in India, then what would have been the interest that you would pay? Now, the difference between the two is actually your interest savings. So, step 3 is the interest adjustment, which is the difference between step 2 and 1. This you will compare with your actual exchange loss, foreign exchange loss. So, in our example, there's a foreign exchange loss of 1,000. When you look at your loan, maybe India had a 12% rate, US had a 2% rate. So, let's say this was $100 into 2%, that comes to $2. At the end of the year, when you actually pay this, the rate is 90, and hence this probably comes to around 180. If you were to take a similar loan in India, this would have been 100. Loan would have been taken at the start of the year when the rate is 80, and hence 8,000 would be the loan into 12%, and hence this comes to 960. So the difference between the two, probably around 780 if I'm not wrong, will be the savings on account of interest. Now, one can say that your total foreign exchange loss is 1,000. However, out of the 1,000, lower of the two is a borrowing cost. Exchange differences, that is 1,000. To the extent they are considered as adjustment to interest cost, that is 780. And hence, lower of the two, that is 780, will be considered to be borrowing cost. But exchange rates change due to various factors. Interest rate is just one of those factors, and hence the remaining, probably 220, will be forex loss. So your journal entry for this would be, loan is a monetary item, will have to be shown at closing rate. So loan will be credited, let us say, at 1,000. What you would debit is borrowing cost for 780, and then forex loss, let us say, for 220, and that will give you your final answer. Your total borrowing cost to be capitalized will be the actual interest that you have paid, 180 plus 780, which is the notional cost that you think which is connected to borrowing, and hence this will give you 960. Remember, all of this will apply if there is a foreign exchange loss. Remember, you might think that there would be a forex loss, but exchange rates again change due to various factors. Let us say India shining, and hence instead of exchange rate going from 80 to 90, it went from 80 to 75, so our rate strengthened, in which case there's a foreign exchange gain. Remember, the heading of the standard is borrowing cost, which means I'm paying probably around 180. That will also be slightly different, but let us say approximately I'm paying 180. That is a cost for me. However, separately, I'm incurring no further cost. In fact, the borrowing is giving me a gain, and the gain will directly go, initial foreign exchange gain will directly go to the profit and loss account. So this kind of takes care of the basics. There is some additional working as well, that what will happen in the subsequent year. Like, for example, if initially there was a forex loss, 80 to 90, and then further in the next year it goes from 90 to 95, there is a further foreign exchange loss, you will follow the same steps. That is, calculate interest, then notional interest, interest saving, exchange differences, everything same. However, what happens if in the next year there is actually a subsequent foreign exchange gain? Now, if there's a subsequent foreign exchange gain, we have just learned that foreign exchange gain should go to the P&L. However, that is if at the initial recognition there's a forex gain. If subsequently there is a gain, in the past you have colored some of the forex losses as borrowing cost. on the guys that you will have to pay. Like you considered 960 as borrowing cost, but out of 960 you have actually paid only 180, the remaining 780 you thought that when I have to repay you will have to pay. However, if the rate in the next year comes down to 85, in which case there is a foreign exchange gain approximately of $5 into 100, so that is around 500 rupees. So this 500 rupees is also notional, so it should have gone to the PNL. However, earlier you recorded this 780 as a borrowing cost, saying that in the future when I have to repay I will have to incur a loss. However, out of this 500 of borrowing cost is never going to happen, or not going to happen at least at the end of the second year. And hence the standard says that something like when you create a provision for bad debt, and if the bad debt is unlikely to happen in the future, you reverse the provision for bad debt. In a similar way, if you have created a notional borrowing cost earlier and later there is a foreign exchange gain, then you can reverse the borrowing cost in the later years. This is very tricky if you understand this well and good, but in the exam, at least this first 6 steps in the first year is more than enough generally. So if I were to understand this, we will say that in the subsequent years, if there's a foreign exchange gain, in the subsequent year, let's say there is a foreign exchange gain of 500, you move from 90 to 85. Then I will say, I will treat this as reversal of borrowing cost. Ideally, loan account debit to loan account debit, because loan is a liability, it's going to reduce loan account debit to. Let us say you will take the lower of the forex gain. The forex gain over here is 500, or borrowing cost. The borrowing cost over here is the notional borrowing cost of 780. Remember, 180 we have actually paid. And hence we are going to say that out of the 780 that you had earlier treated as borrowing cost, 500 will now be reversed. If on the other hand the forex gain was 1500, then I can't take the 1500 as reversal of borrowing cost, because notionally I had earlier considered only 780 as borrowing cost, and hence maximum 780 excess if any will be taken as forex gain. Now that is a lot of theory to go for you. So probably we will try to apply this with the help of, let us say, a question. If you go to your Super 99 file, question number 1, this is your study material question. If you take this as a base, if you want, just pause the video and try the question on your own. Hopefully you should be getting it correct. If not, you can just come back. EBC has a loan of $20,000 for constructing a plant at an interest rate of 5% payable on annual basis, which means your annual interest in dollars will be around $1,000. On 1st April 11, the exchange rate between the currencies was rupees 45 per dollar, and the exchange rate on the reporting date was 48 per dollar, which means there's a 3 rupees loss. You took the loan when the rate was 45, now the rate is 48, so you have to pay 3 rupees more, and hence there is a loss probably of 3 rupees on every dollar, and the loan amount is $20,000. So $20,000 into rupees 3, probably 60,000 is a forex loss. Corresponding amount could have been borrowed by ABC from SBI in India at the local currency of 11% on 1st April 11. So compute the borrowing cost to be capitalized for the construction of plant. So in the first step, you will calculate the actual interest. Actual interest is $1,000, but when do you pay this interest? Well, at the end of the year, when the rate is rupees 48 per dollar, and hence this is going to be rupees 48,000. Second is the notional interest, had the loan been taken in India. Well, had the loan been taken in India, this would have been, okay, this is wrong, I'm sorry. This is, the loan would have been taken in India, this would have been $20,000, equivalent at the rate of 45, and hence I needed probably rupees 9 lakhs, and hence 9 lakhs would be the loan into 11%. So this comes to, let us say, 99,000. So I would have to pay rupees 99,000, and hence the interest savings or interest adjustment is 99,000 minus 48,000, that is equal to 51,000. So over here, 99 minus 48, this is equal to 51. 99 minus 48, which is equal to 51,000. So this is treated as an interest adjustment. So this is my apparent saving in interest. Next, I look at the forex loss. The forex loss over here would be 3 rupees per dollar into 20,000, that is 60,000. So exchange differences, that is 60,000. To the extent they are considered as adjustment to borrowing cost. So exchange differences of 60,000 or interest saving of 51,000, whichever is lower, that is 51,000. I will say that 51,000 out of the 60 is attributable to differences in interest, but exchange rates can change due to various factors, interest rate being one of the factors. The remaining being forex loss, which is equal to 9,000. And hence, when I do this working, I would say that the total borrowing cost to be capitalized would be 48,000 and 51,000. That is a total of 99,000. So the question says, how much is the borrowing cost to be capitalized? The answer should be 99,000 if you apply these steps properly. If you want a much more detailed understanding, you can also figure out that what will happen in the next year. If the exchange rate turns to, let us say, 50, or it becomes 46, or it becomes 43. If it becomes 50, there's an additional forex loss, and you'll follow the same steps even for the second year. But if it becomes either 46 or 43, there is a subsequent foreign exchange gain, and hence you will try to compare that foreign exchange gain with 51,000 and see that how much of the borrowing cost will be reversed, that is a forex gain, or 51,000, whichever is lower. Additional, if any, will be foreign exchange gain in the later years. But that is if you want to go into depth. Otherwise, from an exam perspective, if you just remember this base case, it should generally suffice. Next, you go into capitalization. So we have studied what is a borrowing cost. Now you need to figure out that when should you start capitalizing the borrowing cost, and till when should you continue capitalizing the borrowing cost. Like if I were to buy build a flat in an under construction property. Now the property is going to take 3 years to be ready, but once it is ready, the life of the property is 20 years. I've taken a 15-20 year loan and I'm paying interest. Should I capitalize interest in the first 3 years? Well, yes, that is a period when the asset was getting ready for use. The later years, after the 3 years, the next 15-20 years, should you continue capitalizing the interest? No, the asset is ready for use, and hence the interest, if any, will go to the profit and loss account. So over here, capitalization commences generally when loan is taken and money is spent, expenditure is incurred, work is done. So that is when you will start. You will say that I'm paying borrowing costs and I'm also doing work to construct the qualifying asset. But I will continue capitalizing till when? Well, till the time the asset is ready for use. In the language of the standard, till the time substantially all activities to get the asset in the ready to use condition are complete. Sometimes it might happen that the asset's work is completed, but because of a minor administrative work, the asset is not currently being used. But substantially all activities to get the asset in the ready to use condition are completed, and hence capitalization can possibly stop. So this is when you look at cessation of capitalization. So over here, timing of capitalization, commencement. You will start capitalization at a time which is a later of the date when loan is taken, obvious, because after that only borrowing cost will start, or date when expenditure is incurred. Remember, the entire money need not be spent. You should have spent 10, 15, some percent of the money. So you have started making the payments, expenditure is incurred, or date when activities commence. Activities commence means work on the qualifying asset has started. Like for example, you have taken a loan, you have given money to the contractor to construct a bungalow for you. So loan is taken, expenditure is incurred. However, the contractor over here is kind of has not started the work. You can see that there is no work happening, and as a result, we will say till the time activities to construct the qualifying asset starts, we cannot commence capitalization. It is a later of these three. Activities, does it mean only physical construction has to start? Well, not necessarily. Commencement of activities can also include commencement of activities done in a way. It can also include commencement of activities which are done in a way like site planning, technical evaluation, that can also be treated as commencement of activities. Physical construction need not necessarily start. Okay, so this is when we commence. It is important that you identify commencement date because specific borrowings are capitalized. Even with general borrowing, capitalization starts from the commencement date, but it continues till the time the asset is sold off? No, till the time the asset is ready for use. That is when substantially all activities to get the asset in the ready to use condition is completed. If the asset gets ready for use in parts, then capitalization can also be ceased in parts. So this is cessation. So this is probably 3 years when the building gets ready for use. However, suspension, what do you mean by suspension? It is temporary in nature. It might sometime happen that active development on your asset is interrupted due to some abnormal factors. Like that building gets entangled into a lawsuit, and because of the lawsuit, there is no work happening. Now this is not normal, this is abnormal, and hence the work is interrupted due to an abnormal factor. Now the work gets interrupted for, let us say, 1 year, or let's say 6-8 months. Now that is an extended period of time. Remember, if the work is interrupted only for 1 to 3 days, like maybe there is a Bharat Bandh because of which the work is interrupted for 1 or 2 days, the standard says it is not as material, you can continue capitalizing. However, if the work, active development, is interrupted for an extended period of time. Extended period is not defined, but typically from a student reference, more than 10% of the project life can be treated as extended, but that is not mandatory. So if active development is interrupted due to abnormal factors for an extended period of time, then we say that this is a case of suspension of capitalization, in which case you will not capitalize interest for that period of suspension. There is an interesting question in the RTP of May 24 regarding commencement, suspension, cessation. We have a separate video of RTP May 24. If you want, you can refer that as well. There is one of the questions, I think, of 14, 15, I'm not sure, but you can just refer that once from the RTP if you want to, if you want more clarity on that concept. Okay. Next comes capitalization of borrowing costs. Now there are two types of borrowings. There is a specific borrowing and then there is a general borrowing. What do you mean by specific borrowing? This is a borrowing which is specific, attributable to a qualifying asset only, like a housing loan. A housing loan is taken primarily for the purpose of buying a house only, constructing a house only, so it is a specific borrowing. General borrowing, on the other hand, is a borrowing which is generic in nature. It is not taken for the purpose of a qualifying asset necessary. It may be taken for a general purpose or any purpose, general corporate use. Remember, before we proceed further, one needs to remember that there's a concept of qualifying asset. There's no concept of qualifying borrowings. What do you mean? It means that a borrowing may be only for 6 months, like a bank overdraft, which is generic in nature, can be only for 6 months. However, that is still considered as a borrowing. For the purpose of borrowing cost calculation, we will not say that the borrowing has to be there for more than 12 months and so no. That is for an asset. Any borrowing which is outstanding during the year is eligible borrowing. If that borrowing is directly for a qualifying asset, it is specific. Every borrowing other than a specific borrowing becomes a general borrowing. So over here, if it is a specific borrowing, let us say, the standard says that whatever is the interest is going to be directly attributable to the qualifying asset only. If it is a specific borrowing, whatever is the actual borrowing cost from the commencement date will be attributable to the qualifying asset only, and hence the gross or the actual borrowing cost from the commencement date, the actual amount. So it is very much possible that there is a loan of 100 crores taken on 1st April 2024. Out of this 140 is used for the project on 1st April 24 only. The remaining 60 is used on the project on 1st of July 24. So someone might say that when will we capitalize? Well, if it is a specific borrowing, you will capitalize from 1st April 24 on the entire 100. No sir, 60 was not spent. Okay, so that 60 is surplus, and that surplus might generate income. So income on temporary investment of surplus funds in case of specific borrowings are allowed to be deducted. And hence, if I'm deducting interest, then the cost for that 60 should also be considered. And hence, I will take the entire 100, let us say into 12% for the entire 12 months, and 60 is the income. Let's say the rate of income is 10% into the first 3 months. And that will give me the net borrowing cost to be capitalized. Remember, what is capitalized is only the borrowing cost. You will not go and capitalize KE or WACC. You are fresh from AFM, you say, okay, you take everything. No, the heading of the standard is borrowing cost, not weighted average cost of capital. So if the question says that the accountant wants to capitalize, considering WACC, we will tell the accountant that is wrong. You can capitalize only the borrowing cost. KE, WACC, etc. given in the question, let us say, is irrelevant. Now this is regarding specific borrowing. Now comes general borrowing, which is a little more tricky. General borrowing, as we said, can be any borrowings. It may be borrowings for more than 12 months, less than 12 months, any borrowing. Again, you do not need to do that one-to-one correlation that whether money from the general borrowing is actually used for constructing a qualifying asset or not. For all you know, the money is fungible. You can't identify. There may be a loan taken 8 years back. Do you think the monies of that loan is lying vacant, in the sense unutilized? No, it might be utilized somewhere. The standard believes that if you're constructing a qualifying asset, from where you generate money we don't see, but if you're constructing a qualifying asset, you are spending some money. Had you not spent the money behind the qualifying asset, you could have used that money to repay a borrowing, even a general borrowing, and hence you blame the qualifying asset and say that because I spent 100 rupees behind you, I could not use the 100 rupees to pay a particular loan, and hence the interest that I'm paying on that loan is attributable to you. That is the general thought process of the standard. So a lot of students get confused when they do one-to-one. They say, okay, this loan was taken 4 years back, the money was used, let it be used anywhere. if I did not spend new money on the qualifying asset, I could have theoretically used that money to repay a part of this loan, and hence interest attributable to the money spent behind the qualifying asset will be attributable to the borrowing cost for that will be attributable to the qualifying asset. Okay, so it is a little technical, but nevertheless, if you kind of understand it first with some theory, and then we kind of possibly do a numerical question as well. Over here, let us say, when we look at, let us say, the borrowing cost. First, in a question, there can be specific as well as general borrowings. If it is specific borrowing, very easy. You will take the actual borrowing cost from the commencement date, less income on temporary investment, whatever is the net borrowing cost, you capitalize. Next problem is you come to other borrowings. Now, the problem is, as we said earlier, money is fungible. You can't identify. Like your company might have 100 rupees of specific or 40 rupees of specific loan. It might have 200 rupees of a term loan at 10% general, 300 rupees of a debenture, 15% general. And there might be 500 rupees of equity share capital. Now in your bank, you might have 1040 rupees. You write a check for 100 rupees. How will I know that 100 is going from where? My revised bank balance is 940. I don't know from where it is going, and hence standardization is needed. So standardization says that the amount will be utilized out of the specific borrowing. So whatever you're spending first will be utilized out of the specific borrowings. Once the specific borrowings are exhausted, then the money will be utilized from the general borrowings. Now there may be two general borrowings. Which of the general borrowings it is utilized? Well, we will say that this will be utilized from a weighted average pool of borrowings. I will not do that one-to-one matching. I will not say that it is from the 200 rupee loan or from the 300 rupee loan. I will say that in total, for example, I might have a general borrowing of 200, on which I am paying probably interest of 20 rupees, 10%. I also have another general borrowing of 300, let us say, on which I am paying interest at the rate of 15%, 300 to 15%, 45. And hence, I am paying total 65 on a total borrowing pool of 500, which means for every rupee of general borrowing that is utilized for a qualifying asset, for example, 13% is the borrowing cost. So I'm saying that if I'm spending 100 rupees behind a qualifying asset, the first 40 rupees is from specific borrowings. The remaining 60 rupees is from general borrowings. But which general borrowings? Well, I don't know. So I will say that what is the cost behind every general borrowing? Well, every rupee taken out of the general borrowing, let us say, has a 13% cost. And as a result, if 60 rupees is taken out of the general borrowing, 16 to 13% simplistically is going to give you, let us say, your eligible borrowing cost. If I take 60 into 13%, simplistically, that is 7.8 rupees. Now I'm actually paying a borrowing cost of 65, but I'm saying the entire 65 is not towards the qualifying asset. A part of this, at max 7.8, is towards the qualifying asset. The remaining is for other than qualifying asset. You can very well take it to the P&L. So you will compare the eligible borrowing cost to be capitalized with the actual borrowing cost, select whichever is lower, and that is the borrowing cost to be capitalized. So over here, first I will look at borrowing costs from specific borrowings. Next, you will try to find a weighted average borrowing rate. For the weighted average borrowing rate, you will take actual interest on the general borrowings and time-based weight in the denominator. So this is, in my opinion, important. Sometimes institute only asks you question regarding capitalization rate. We will discuss this further. Sometimes you might have a company-specific WABR, capitalization rate, like a company might have hundreds of projects, tens of borrowings. For me to find for each project when it was taken, what was the borrowing then might be taxing. So I would say I will take the entire year, find out what is the actual borrowing cost for the company, and then find the weighted average borrowing rate, apply that. Like when I look at inventory, I follow weighted average method. So if I have hundreds and thousands of inventory units, I don't sit and find the cost of each unit. I say average cost. However, if I have a few units like paintings, I have 10, 15 paintings, I can do specific identification. I can exactly find that for this painting, what is the cost. In a similar way, if my company has hardly one or two projects, I can actually sit and find what is the rate specific to that project, in which case it is a project specific weighted average borrowing rate. Generally, what is more accurate is a project specific weighted average borrowing rate, but companies in the past have also used company specific borrowing rate. There is one particular sum in the study material. If time permits, we will also try to do that, which is a little controversial. Two different alternative solutions are there. So if possible, we will discuss that and what are the possibilities for that particular question as well. Then you find the eligible borrowing cost, which is based on expenditure incurred on the qualifying asset after deducting the amount from specific borrowings. Then whatever is left over, we take that. So out of 100, 40 is from specific, remaining 60 is from general, into the 13% rate into the time period for which it was utilized. And the borrowing cost will be the eligible borrowing cost. In our example, I think we got around 7.8, or the actual borrowing cost, which was 65, whichever is kind of lower. And this will give you the total borrowing cost to be capitalized. Now there's an example over here, and there's also some theory on expenditure incurred, but we will try to best understand this with the numerical. We have done again a lot of theory. It kind of will cement if you kind of do this through an example. So question 2 is an important question. So let us review this. On 1st April 2011, Entity A contracted for construction of a building for 22 lakhs. The land under the building is recognized as a separate asset and is not a part of the qualifying assets. So land is separate, we are just looking at building. The building was completed by the end of March, so it took a good 12 months, so it is generally a qualifying asset. And during this period, the following payments were made to the contractor. So you have a set of payments, totaling up everything is in thousands, to 2200 in thousands, that is 22 lakhs. A's borrowings at its year end. So these are borrowings at the year end on 31st March 12 were given below. There's a 10% 4-year note with simple interest payable annually, which relates specifically to the project. What does this language mean? This means that this is a specific borrowing attributable to the project only. Debt outstanding at the end of the year is 7 lakhs. This is on 31st March 12. Interest of 65,000 was incurred on these borrowings during the year, and interest income of 20,000 was earned on the funds which are held in anticipation of payments. Now what happens a lot of times is students sit and back calculate. They say 7 lakh into 10% will come to 70,000. How is the interest 65,000? We don't know the exact mechanics. We know that at the end of the year there is 7 lakhs of loan. Maybe you must have drawn down around 3 or 4 lakhs. On 1st April, maybe you would have drawn down the remaining amount later. We don't know how that 65,000 is calculated, but honestly, we don't even need to bother about that. Because if it is specific borrowing, you will take the actual borrowing cost, which is 65, and subtract the income on temporary investment, which is 20, and hence 45,000, which is the net borrowing cost, which will be capitalized. Okay, this is specific. Then is a 12.5% 10-year note with simple interest payable annually. Debt outstanding on 1st April 11, which is a start, is 10 lakhs and remained unchanged during the year. So there's no change over here. 10 lakhs is there for the entire year. This is not specifically for this asset and hence it is general. Another 10% 10-year note with simple interest payable annually. Debt outstanding at 1st April 11 was 15 lakhs and again it remained unchanged. Again, it is not specifically for the qualifying asset and hence it is general. So what do I need to do? I know that specific borrowings 45,000 is to be capitalized. For general borrowings, I need to calculate weighted average borrowing rate, which will be 12.5% of 10 lakhs, which is 1,25,000 plus 10% of 15 lakhs, which is 1,50,000. So this is the actual borrowing cost that you are incurring throughout the year for a borrowing which is worth 10 lakhs and then a borrowing which is worth 15 lakhs. And hence, if I go to see, I'm effectively paying 2,75,000 for a borrowing pool of 25 lakhs, which means for every rupee on an average, I'm paying 11%. And hence, if I were to see the weighted average borrowing rate, it comes to 11%. But my job in this question is to find the amount of borrowing cost to be capitalized at the end of the year. I can say on specific 45 is to be capitalized, but what about general? Well, 11% is the rate, but my borrowings may be 25 lakhs. This 25 lakhs may not necessarily be used for a qualifying asset. So I will capitalize out of this only that part which is utilized for a qualifying asset. So I will say that the first set of expenditure was done on 1st April. In this question, I can say 2 lakhs or 200,000 was spent on 1st April. However, was there a specific borrowing? Yes. And hence, for all you know, this 200 would have been spent first out of the specific borrowings. Specific borrowings are 7 lakhs in total. And hence, at least 2 lakhs must have been drawn by 1st of April. And I must have used this for the qualifying asset. So, on the first day, nothing is used from the general borrowing. I still have 5 lakhs remaining in my specific borrowing because loan is 7 lakhs, out of which 2 lakhs is utilized, remaining 5 lakhs is there. Next on 30th June, I make the next set of payment of 6 lakhs, out of which I can say 500, that is 5 lakhs, would be used out of the specific borrowing, which means the remaining 100 will be used out of the general borrowings. That 100 is carrying a cost of 11% per annum, but I have not used this borrowing for the entire year. I have used it from 30th June. Before that, it must have been deployed somewhere. We don't care. It's a general borrowing. But beyond this, it is attributable to the qualifying asset and hence into 9 by 12. Similarly, now the specific borrowing is entirely utilized and hence any further expenditure will be financed out of the general borrowing only. This is on 31st December, which is 3 months, and last is 31st March. Now this is on the very last day of the year and hence there will be no separate interest. So if I do the working, this is 0, this is 100 into 11% into 9 by 12, probably 8.25, and then this is 1200 into 11% into 3 by 12, this is probably 33, approximately this is 0 and hence this is 41.25. So I'm actually paying 2,75,000 of borrowing cost on general borrowings, out of which I believe 41,250 is attributable to a qualifying asset. This is within the limit and hence we can say that the borrowing cost to be capitalized will be 45,000 out of the specific borrowings and 41,250 out of the general borrowings, and hence this is 86,250. So once you do this numerical, this is a typical exam grade question which can be asked. If you are comfortable with this, it is quite a good coverage from an exam perspective. Now there are a few other points. What in the standard, the last a couple of points over here would be, what if there is data regarding expenditure incurred? Now till now we have only focused on borrowings, borrowing costs, etc. But is it possible that there can be, I mean, you have always been given, like in the last question, you have been told 22 lakhs is the expenditure on qualifying asset and you have been given the breakup. But in that 22 lakhs, what is going? Cash payments, what you actually pay to the laborers for material, etc. Should that be a part of the expenditure incurred? Of course. But sometimes you might have assets, and that assets are used for the purpose of construction of qualifying asset. Like for example, you might have a bag of 20 tons of cement with you. You are now constructing a qualifying asset. You are transferring that cement. Is that expenditure incurred for qualifying asset? Of course. Or you want to do redevelopment, and for redevelopment you have an old building, or you are buying an old building, demolishing and constructing a new building. So even the building that is used, or there is some expenditure which is incurred in the form of assets which is transferred, will that also be a part of your total expenditure on qualifying asset? Of course. So basically expenditure incurred will include cash payments plus transfer of assets for the purpose of construction, but you will also include interest already capitalized. Now what happens is, let us say in the last question we said that 22 lakhs, for example, was the total expenditure that you incurred for the purpose of construction of the qualifying asset. This was 22 lakhs. So if I look at my building account, machinery account, whatever it is, I will see 22 lakhs, yes. But at the end, did I also capitalize 86,250 in the earlier question that we discussed? Yes. So if someone says, what is the money that you have spent for the qualifying asset? I will say 22 lakhs I have spent, yes. But over and above that, 86,250 of interest, which was also attributable to the qualifying asset. And hence, I have probably 22, 86,250. And hence, interest cost, which is already capitalized, will also be a part of your expenditure incurred for the purpose of qualifying asset. Now sometimes the government might give you a grant and hence you might incur all of this expense, but the government is giving you, let us say, a reimbursement of 10 lakhs. In which case for you that 10 lakhs will reduce the expenditure incurred behind the qualifying asset, or sometimes some other customer or party might give you reimbursement, progress payments for this. So you will subtract this, grants or any other progress payments received. So basically expenditure incurred on qualifying asset will include cash payments plus transfer of assets plus interest already capitalized minus grants or other progress payments received. A couple of points for you to note over here would be that sometimes it might happen that your expenditure incurred as per accrual and cash paid might be different. Like for example, you have bought a flat in an under construction property. The builder calls upon you to pay 10 lakhs because some part of slabs are laid. You don't pay 10 lakhs, you pay only 2 lakhs. So as per accrual, you are supposed to pay 10 lakhs, but you are paying only 2 lakhs. Think and tell me, you are actually incurring borrowing cost On how much? Well, on 10 or 2? Well, on 2 lakhs. And hence, for the limited purpose of determining the expenditure incurred behind the qualifying asset, we would say that 2 lakhs is going to be drawn out of maybe general or specific borrowings to be used towards this qualifying asset. And as a result, cash payments and not expenses accrued will be used as a basis for determining the borrowing cost. So this is an interesting thing. And there is, so we will do a detailed sum on this as well. And the last part over here is borrowing costs in case of a consolidated financial statements. Now, usually what we have done till now clearly helps you in understanding what is a borrowing cost treatment in SFS. But a few nuances can be there in CFS. Like for example, there may be intercompany loans. So there may be a company which has taken a loan at the rate of 7%. It does not have any qualifying asset. A parent company, it gives a loan to its subsidiary at 8%. Now, in my parent company's books, there is no qualifying asset only. However, in the subsidiary's books, it has taken 8% loan from the parent, and that loan it has used for the purpose of construction of a qualifying asset. So in subsidiaries SFS, it will capitalize interest at the rate of 8%. However, when I do CFS, the 8% loan given and 8% loan taken eliminates. And hence for the group as a whole, which is a separate reporting, I will say there's a 7% loan taken from an external party and there's a qualifying asset. So at a CFS level, you will capitalize interest only at 7%. Remember, CFS is a separate set of accounts, SFS is a separate set of accounts. Further, another case would be that sometimes a parent company might construct a qualifying asset for the subsidiary. So for the subsidiary, maybe the asset is costing 15 lakh 40. And hence it has capitalized borrowing cost on 15 lakh 40 that it has paid to the parent for construction. But parent has charged a profit margin of 1 lakh 40,000. Now what happens is, in the SFS, it is fine. Parent is a contractor, it has incurred cost of 14 lakhs, sold it at 1540, subsidiary has recorded it as 1540 and borrowing cost is capitalized. But when I do CFS, that 1 lakh 40 of intercompany profit has to be eliminated. And hence for the group as a whole, the asset will appear at 14 lakhs only, and hence the capitalization can be done on 14 lakhs only. And then the third case over here can be that it is very much possible that there is a qualifying asset in a company, but there is no loan at the SFS level. So there is no borrowing cost. Another subsidiary in a group might have loans, but no qualifying asset. But when you consolidate them, there will be in the CFS loan also, there will be qualifying asset also. So irrespective of what has happened in the SFS, at the CFS level, you will attribute the borrowing cost on that loan to the qualifying asset and show the workings. So this is how you will do. There is a sum in the study material for this. You can refer that if you want more clarity. But nevertheless, I think the basic discussion to this level, at least from an exam perspective, kind of suffices. Now there is one more interesting question that we should have covered. I want to do this right now. This is on RTP May 23. We also have a separate YouTube video on this. You can refer that. However, this sum is also an important question. This has some history. It came in the RTP May 23. Then it again came in one of the MTPs of May 24. There was some error. It again got rectified, and now the solutions are consistent in the RTP, in the MTP, and in our books. So this is something which is also important, and this is something which you should also do. So over here, let us say we go to question number 3. If you don't have this handy, it is the RTP May 23 question. LT Limited is in the process of constructing a building. The construction process is expected to take around 18 months from 1st January 11 to 30th June 12. So that is an 18-month substantial period of time, definitely a qualifying asset. The building meets the definition of a qualifying asset. LT incurs the following expenditure for construction. So you have been given expenses of 5 and 20 on 2 dates, and then 20 and 5. So a total, it seems 25 and 25, that is 50 of total expenses. On 1st July 11, LT issued 10% redeemable debentures. When you're issuing debenture, that means you're borrowing, of 50 crores. This is on 1st July 11. The proceeds from the debentures form part of the company's general borrowings, very clearly told, which it uses to finance construction of qualifying asset as well. That is building. LT has no borrowings, general or specific, before 1st July. So this is a very interesting situation where there is no borrowings before 1st of July and did not incur any borrowing cost before that date as well. Okay, but was it incurring certain expenses? Well, yes, on 1st July, 1st January it incurred certain expenses, that is 5 crores. On another 30th June it incurred further expenses, which is about 20 crores. Okay. But there was no corresponding borrowings. If there is no borrowings, I cannot capitalize a borrowing cost. LT incurred 25 crores of construction costs before obtaining the general borrowing, that is 5 and 20. On 1st July 11, this is pre-borrowing expenditure, and 25 crores of after obtaining the general borrowing, post-borrowing expenditure. This is this 25 crores. For each of the financial year ended 11, 12 and 13, calculate the borrowing cost that LT is permitted to capitalize as a part of the building cost. Now over here one needs to be remembered that borrowing cost is to be attributable to a qualifying asset. In case of general borrowing, I don't have to do a one-to-one matching. I will say that if there is a borrowing cost, yes. Is there is a qualifying asset, yes, I will attribute. First, I look at the year 10-11. In the year 10-11, I am incurring 5 crores worth of expenditure. However, in the year 10-11, I don't have a borrowing, and hence can I capitalize any borrowing cost? The answer is no. So in the year 10-11, there is nil borrowing cost to be capitalized because there is no actual interest. However, when you go to the year 11-12, in the year 11-12, there is no specific borrowing, but there is a general borrowing, there is single general borrowing, and hence the weighted average borrowing rate is the same rate as that of the borrowing, which is 10%. So ideally 10% should be attributable to this borrowing. WABR is 10%. Now we look at the discussion of expenditure incurred. Now a student might say that, well, when the loan was taken, listen to this carefully, when the loan was taken on 1st July, the expenditure is already incurred, and hence no part of this 50 crores is actually going behind the expenditure. You don't have to do this one-to-one matching. The standard says that expenditure incurred behind the qualifying asset, that is cash payments. Have you done any cash payments? Well, till date, if you open the CWIP account, capital work in progress, you will see 5 and 20, that is 25, appearing in your CWIP account. So there are cash payments, that is expenditure is incurred. Now from 1st July onwards, you are taking a loan, and the loan is open for the next 9 months as well. Now a student might say that during this 9 months, this loan is there, but the money was already spent. That again you are doing one-to-one matching. The language of the law says that had there been no qualifying asset, had you never spent at 5 and never spent at 20, then probably today I will not need to take a loan of 50 crores. I might have 25 with me handy, and hence that 25, interest on that 25 is also attributable to a qualifying asset. Now you will say that this is a little illogical, maybe not, but the standard clearly tells us to do that, and this is in the interest of larger corporate reporting, because otherwise if you have to do one-to-one match-up for everything, it will become very tedious. So they say that the borrowing cost attributable is a borrowing cost that could have been avoided had there been no expenditure on qualifying asset. Had you not spent that 5 and 20 earlier, that is a 25 on 1st January as well as 30th June, then probably that 25 will be there with you, and hence you might not need a 50 crore borrowing. You might be happy with even a lower borrowing. So the fact that you had to take a 50 crore borrowing, 25 of that is attributable to the fact that you've already spent some money behind the qualifying asset. Zabardasti, you will have to capitalize borrowing cost. So over here, keeping that concept in mind, we will say expenditure incurred till date is 25 till 1st July, on which into 10% into 9 by 12. So if I do this working, approximately 1.875. The next expenditure is incurred on 31st March, but that is on the last day, and hence there is no separate borrowing cost to be capitalized for that. Now if I open my CWIP account, if I go to the year 12-13, the asset is getting ready for use on, I think, 30th June. So if I open my capital work in progress or CWIP account on 1st April 2012, I will see expenditure incurred behind the qualifying asset. How much is incurred? Well, 5 was incurred earlier, then 20 was incurred, then another 20, this one was incurred, and hence I will say that this is 45 incurred towards direct operating expenditure on a qualifying asset. But is that it? Well, no. There's also interest of 1.875. Now this interest of 1.875 is also attributable to the capital work in progress. You must have passed the entry interest account debit to bank, and then a part of this, that is asset account debit 1.875 to interest, and hence the expenditure incurred on the qualifying asset we had studied includes cash payment, transfer of assets, as well as interest already capitalized. In the first year nothing was capitalized, but in the second year 1.875 was capitalized. So the expenditure incurred as on 1st April 2012 for the qualifying asset is actually 46.85. 875. Now over here there was a journey, as I said earlier, in the RTP as well as in the MTP. Institute had not taken this 1.875. Then they later realized their mistake and they included it. So the solutions have been rectified to include 1.875. It is there in our solution as well as the ICI solution if you go to see. So 46.875 is the expenditure incurred behind the qualifying asset. Now this will continue for the next 3 months, that is till 30th June when it gets ready for use. On 30th June you are again spending 5 crores, but this is the last day, the asset is ready for use, and hence the borrowing cost to be capitalized would be 46.875 into, let us say, I think 10% into 3 by 12, and hence 46.875 into 10% into 3 by 12 comes to I think 1.178 or something, and this will be the borrowing cost that we are going to capitalize. So over here in the first year nil, in the second year if you go to see this is 1.875, and in the last year if you go to see this is approximately 1.17. You compare it with the actual borrowing cost of 50 crores at the rate of 10% for 3 months, 1.25, so you can capitalize 1.17. So I hope this has been helpful for you, and this takes care by and large of borrowing cost. Now there's also one more problem that I intend to discuss over here. It is not there in this, but it kind of poses a lot of challenge for a lot of students. This is question number 3 in your study material. We would just quickly want to discuss this. This is based on the concept of the weighted average borrowing rate at a company level or a project level. Solution is different in suggested answers and in study material. I would now recommend you do the solution as per the study material, because in the May 24 material they have changed a lot of things where they thought it was erroneous. They have not changed this, and hence earlier we used to say that suggested answers we can also take, but now if in the new study material also it is done in a particular way, you do it on that way only. So over here an entity constructs a new head office commencing on 1st September which continues till 31st December. For these 4 months, directly attributable expenses are given as 1 lakh, 2 lakh 50 in each of the months. That's fine. The entity has not taken any specific borrowings to finance the construction, but has incurred finance cost on its general borrowings. During the year, entity has 10% debentures with a face value of rupees 20 lakhs and paid an overdraft of 5 lakhs, which increased to 7 lakh 50 in December. Interest was paid on the overdraft at 15% and then was increased to 16%. Calculate the capitalization rate for computing in accordance with Ind AS 23. Now if I go to see, there are 2 ways. One is a project specific WABR, which is there in the ICAI study material, which is what you should now use, or project specific WABR means a WABR exclusive for this project only, or an overall company specific WABR, which is usually used for companies where you have multiple projects, which was used in the suggested answers of November 19 if you go to see. We will discuss both of these, but in the exam, if this similar thing comes, we will follow the recent ICI study material, which says that what is the borrowing cost during those 4 months. During the 4 months, if you go to see, there was a 20 lakh, I think debenture, so 20 lakh into, let us say, I think 10% into 4 by 12, that is September to December. Next, for bank overdraft, which is also a general borrowing, 5 lakhs into, the rate was 15% for 1 month out of those 4 months, and then 5 lakhs continues into 16%, I think, for the next 2 months. This is October and November, and now in the last month 7.5 lakhs into, let us say, 16% for the 1 month. So this will be your actual interest. If you go to see, your actual interest will be around 96,250. You take 96,250. In the denominator, there are 2 ways in which you can solve. You can say 20 lakhs into 4 by 4, in which case you are taking only 4 months, and hence the rate will be a 4-month rate. Or you take into 4 by 12, in which case you are taking 12 months per annum, in which case the rate will be 12 per annum rate. Either way you do, ultimate answer is the same. Plus 5 lakhs into 11 by 12. Plus, let us say 7.5 lakhs, sorry, not 11, 3 out of those relevant months, 3 out of 12, and 7.5 into 1 by 12. So if I do this working, this is 20 into 4 by 12 m plus 5 into 3 by 12 m plus 7.5 divided by 12 m plus 7.5 divided by 12 m plus MRC. So this is around 8,51,167 into 100. If you calculate 96,250 divided by 8, 51,167, this comes to approximately 11.3% or something. This comes to around 11.3% if I'm not wrong. If these numbers are correct, 20 lakhs into 4 by 12 m plus 5 lakhs into 3 by 12 m plus 7 lakh 50 into 1 by 12 m plus 854 167. This is 854. So this is 96,250 upon 854 167 in percentage comes to 11.27 approximately. So this is 11.27, but this is per annum because in the denominator you have taken 12 months as the base. Institute over here has taken 4 by 4, 3 by 4 and 1 by 4, which is also fine. Here if you say 11.27% is per annum, that is nothing but 11.27% per annum. Then for 4 months, which is the project period, this is 11.27 into 4 by 12 and you will get exactly 3.756 or 7.7. This is a rate for 4 months, which is what you will see in the printed solution, 3.756 exactly. What they have done is they've just taken 4 as a base. Having said that, if you even take 12 as a base, no problem, your answer will come as a percentage per annum rate. This is the WABR to be used only for this particular project. So this is what you should do if it comes in the exam. Just for your knowledge, in the older setup, what they did is they took the same actual interest, but they said that this is going to be done for the entire 12 months. So this is 20 lakhs into 10% for 12 by 12. Sir, but the project was not there in the earlier 7-8 months. That's fine. I'm trying to do it for the company as a whole, and then for every project that the company takes during the year, I will apply the same rate. Plus 5 lakhs into 15%. This time you will take around 9 by 12. This is for 9 months. Plus 5 lakhs into 16% into 2 by 12 plus 7.5 into 16% into 1 by 12. This will give you the actual interest for the entire 12 months. So in the denominator, you will take 20 into 12 by 12 plus 5 into 11 by 12 plus 7.5 into 1 by 12. If I do this working, this will come to approximately 11.09% per annum, which is different. Why? Because, well, this is the WABR for the entire 12 months. This is a slightly less accurate number. This is like weighted average cost in inventory, which I'm saying that, well, inventory might be purchased at 10, might be purchased at 12, might be purchased at 15. On an average, it is 12.5. So every inventory unit is 12.5. Here, different projects may be at different times. I'm saying that I don't have the time to kind of find the WBR for each project based on the time frame that they have. So I will do it for the company as a whole, which is 11.09% applied to every project. In the case which is there in the ICI SM, what they have done is, I'm saying for the first 7 months, 8 months, what is happening is irrelevant. My project is starting on 1st September. So I will look at only those 4 months and solve. If it comes in the exam now, in the revised setup, I will suggest you take the ICI SM, because in May 24 SM, they've changed various things. Earlier, we used to say that you can also follow suggested answer, but now it is preferable if you stick to the SM, because now if the suggested answer comes, it is very likely to come on the lines of the ICI SM only. So I hope this discussion has also kind of helped you a little. Otherwise, that should take care of Ind AS 23 on borrowing cost. I hope this has helped you and wish you all the best for your preparations. If you like the video, please do like, share and subscribe and share it with your friends. See you then. Till next time and till the next revision video. Goodbye, good luck and take care.